Welcome to another episode of the Property Prescription. We've got Saskia again.
Yep, happy to be
here.
So
third episode, well done.
Yep, thanks.
You're experienced now. You've got it all under your belt.
Yeah, I'm a professional.
Now today we're going to talk about, as a result of some of the changes, new versus established residential property, of course. Now as a business, we've always concentrated on established property. We've bought established commercial, residential, all different types. But we haven't bought a lot of new property. So I'd like to just talk in today's episode and let's just dissect that. And go through new versus established and some of the merits of new.
There's a lot to break down here. To start with, I think we are a data-driven business, and despite the fact that I think in the past, honestly, we have had biases towards preferring established property. But when we went back and looked at the data, we realized that new property absolutely does go on runs. It just does. If the general region has a supply and demand imbalance, it's going to push prices up. People need a place to live at the end of the day. So obviously all new property is not equal by far. Definitely not equal.
There are good and bad parts of new property as well.
And operators in the business, and you have to really do your due diligence there. So I think there is this tendency for people to stamp new property as all being the exact same thing, and that's just not the case. We have to have a bit more nuance around the story there.
Let's talk about lending ratios as well, new versus established. So you're seeing some of our doctors in terms of their ability to get funding as well in terms of their new loans. Do you want to just touch on that? Yeah,
absolutely. So some lenders are saying that without negative gearing benefits, their approval for an investment property has gone down about 20%. So if we've got $700,000 in the first place, we're going back to $560,000, if I've done my maths correctly.
Yes.
If that happens and we're at a point where now you only have the budget to purchase something that's compromised, that's not going to perform well, that's not a position that we would ever want to put a client in. So that's when the story of buying new to take advantage of the higher lending capacity does become more attractive.
And you get some of the sort of depreciation benefits, which was always a really ugly word that when we used to have a number of groups approach us as a business and say, do you want to go and buy a house and land package in this particular area? There is the cost of construction argument as well that we've discussed. There's infill versus greenfill type assets. So greenfill are predominantly the master plan communities and growth corridors across the capital cities. So let's just talk about established and the quality versus new. And if we're looking at a doctor's portfolio, new versus established, and how do you see that?
Well, it's always about having a balanced portfolio. I think that historically the reality is that established does generally perform a little bit better than new. Mainly because when we're talking about a supply and demand imbalance, if there is an influx of new property coming on in an area, the scales tip a bit. So that's what sort of makes it not grow at the same rate that established property does, at least in the beginning when a bunch of stock is brought to the market. So, but we have to balance that with the ability to service your portfolio. That's the reality. And if you have that option of either a $700,000 approval for a new property versus $560,000 for a compromised property that you might have trouble servicing and cause you problems, then and absolutely don't sit there and do nothing with your money. That's probably the worst case scenario.
You see a lot of doctors not doing anything.
Exactly. You might as well go for, if you have the right property, the right new property, even if you're getting a little bit of a lower return on your cash.
And we've modelled this out in the white paper that you've prepared, and the timeline in terms of where it takes you to get to that same outcome as established. What sort of timeline are we looking at?
We're looking at closer to 8 to 11 years versus our usual 6 to 9 year investment timeline. So you're going to have a bit more patience, but again, it's worth going into an investment and getting something for your money than just sitting on your hands and doing nothing. But as I've sort of indicated, the preference for us generally is established.
Yeah, absolutely. I think, moving forward with our doctors' portfolio, especially our younger doctors, they'll buy one established property and then they may buy a newly sort of developed asset, whether it's greenfill or infill. But there is a golden rule. And what is that golden rule that we've obviously discussed as an investment committee?
We need to be able to sell it to an owner-occupier in 10 years' time. That's really crucial.
That is fundamentally important, whether or not this works or not, for a young doctor looking to get into the market. Mm-hmm. And I think it's really important that whatever we're analysing and whatever master plan community that we're looking at buying in, that is imperative that an investor doesn't buy that property.
Yep.
An owner-occupier, because they're going to end up paying a little bit more of a premium than an investor.
Yep, absolutely.
And the other thing that we've studied, and you've looked into it quite well, is obviously the rental growth that occurs in some of these sort of newly developed assets can be a little bit inferior to established as well. So do you want to just talk about that?
Yeah, it can be a little bit inferior, but you also do start off with a better net yield position.
Yeah.
So the cash burn is going to be much better, especially with the new negative gearing. We've done a podcast on that already. If you want to redirect to that one as well. But you start off in a better cash burn position.
Yeah. So this is more around structuring the doctor's portfolio. It's more focusing on having a balanced portfolio rather than just being so heavily growth focused.
Yep.
And I think the number one issue that we're probably looking at with our doctors at the moment is your cash flow management. It's really, really important with the advisors that are looking at these doctors' portfolio. They're actually analysing the cash flow and the serviceability, and you're actually in a really good outcome for you in terms of the depreciation benefits that you do get. So
yeah, you are. But I suppose depreciation is also sometimes a bit misunderstood, because that does, when you exit on your capital gains, it comes back to
correct
haunt you a bit.
Correct.
Yeah.
Yes.
Yeah. So it's really just important to keep in mind that when we're talking now about the new versus established, which I don't want to pit them against each other, because there's places for both of them. But really, one is you've got consistent and starting off with the benefits, and maybe you don't reap that at the end as much, versus established is just the opposite scenario. It's a bit more cash burn, a bit harder to get into, and you reap the benefits at the end.
Absolutely. And I think there's really good entry points for both in that sort of 600K or above. So even if you're a young doctor looking to get into the market, you can buy a good quality established property, and you can buy a really well located, well researched new property and get it and actually continue to grow your portfolio. It's just going to take a little bit longer on the newly built assets.
Yes. So, and I think that it's really important that the investment story of the macro market that you're looking at has to be tight. It has to be locked up. There has to be a really strong story there. You can't just be going and buying in any random area. It has to be data backed. There has to be a supply and demand imbalance, as we keep coming back to.
Keep talking about it.
Yep.
So this white paper really dissects that sort of new versus established argument.
Yeah.
And I think summarizing and action points, they all play a part in the doctor's end outcome in part of building their portfolio. And we can talk about commercial property as well in terms of putting that into the doctor's portfolio as well. But really, we just really want to just break down new versus established.
Yeah, because that's what's really creating the panic at the moment, I think. And as much as market sentiment absolutely does have an impact short term on prices and the softness of a market, but at the end of the day, it can't affect those underlying supply and demand fundamentals in such a rapid way. It takes years for property to get brought onto the market with migration and whatnot. It's not this overnight flick of a switch that it sort of has seemed like in the media.
Absolutely. So you still get the negative gearing benefits, and you can actually negatively gear a good quality infill newly built asset. There's different strategies that we've seen being presented to us, people buying their homes and then getting the negative gearing benefit. There are people out there within the capital cities buying blocks of land and then building 2 townhouses on the one site. Now, you don't get the negative gearing benefit if you don't make any particular change if it's one single dwelling, but blocks of units where There's a lot of grey areas there that
there is.
I don't think government have fully finished their paper there.
Yeah. Well, I think in general, it's important to note that the legislation isn't out yet.
It is not. It has not been approved
honestly,
just yet.
There's been so much confusion amongst all professionals, to be quite honest. Like there are a lot of holes in the story at the moment that are yet to be filled, and we are still waiting for those final puzzle pieces to be understood.
You still have to value the property every year as well, as part of that modelling as well. So I think valuers are going to do really well in terms of what a valuation represents and what it means when you're valuing the doctor's portfolio.
Yep.
So I think that's really, really important. And I think just managing the portfolio and actively managing the portfolio is going to be really important moving forward.
Yeah, definitely. Constant contact with your advisor is really important. And obviously as the political landscape changes, we're going to be doing many more late nights, I'm sure, in the coming few years, and we'll be here to make sure the right decisions are made.
They still haven't finalised the papers. There are still a number of grey areas there. So the best people that I think are going to be really winning are accountants.
Yes.
They're going to be so busy. How we interpret this, how the accountant interprets, and even the accountants are a little bit confused around what is actually going to be presented over the next 6 to 12 months as some of these papers are written. Yep. So concerning, but making sure you've got the right advice team, having someone like ourselves, great accountant, great broker, making sure you're getting the right advice is really imperative in terms of building your portfolio.
Yep.
So we'll end it there. Thanks very much, Saskia, for joining us.
Thanks for having me. Appreciate it, Phil.
Cheers.